Actually, ang aton nga requirements, we have three. Number one is to prepare a schedule to compute the translation adjustment for the year, assuming that the functional currency is the US dollars. Now, functional currency is the local currency unit. So we have now the translation into the presentation currency. Then, in the case of our solution to number one, take note that the functional currency is the local currency unit, that is the US dollars. And then the translation into the presentation currency, which will be the current or the closing rate method. Now we have the pesos. So take note that we are guided by the rules regarding what rate to be used. Yesterday, I tried to focus on the rates to be used under the current method and the temporal method, temporal or remeasurement method. Now, there are really differences that we have to take into account, which will materially affect our statements. So in the case of number one, we are using the current or the closing rate method, and take note that all the income and expenses accounts are to be presented or translated by using the average rate, and the average rate for the year is 40.20, applying to all our nominal accounts in our combined statement of income and retained earnings. So we have the amounts in pesos, I mean in dollars, and then we just convert this, multiply these amounts by the exchange rate applicable, so that for all the nominal accounts found in our statement of income, we have to multiply the amounts in dollars by 40.20, being the average for the year. So that means for sales down to income tax expense. So giving us the net income that will be added to retained earnings of $399,600, now converted to pesos. And then we have the retained earnings on January 1. The applied rate here is 40. And that 40 is the rate as of January 2, 20x4. So we get 23,040,000. We have the total, and then we deduct the dividends that were declared on September 1, 20x4. So we now use the rate of 40.10, giving us the retained earnings and now the retained earnings and will be carried forward to your uh, balance sheet. So the last item in the balance sheet before the total is 615,600. That's now your retained earnings at the end of the period. Again, take note that your items of assets and liabilities, we are using the current method or the current rate method, and the rule is all assets and liabilities should be translated by using the closing rate or the spot rate. So given the book, we have the rate of 40.25. We simply multiply this by all our assets, cash down to equipment. So we now get your total assets in US dollars and as converted with the same rates. We are using the current rate method. Now, the same with liabilities. accounts payable, short-term notes payable, and bonds payable still translated by using the spot rate of 40.25. That's why C means the current exchange rate. Next, for the common stock at 10 peso par, 1,152 US dollars, we translate this by using the historical rate and given is 40. We also have this rate applied to paid in capital in excess of par. So we now get your total of 4,737,600. That's now your total in terms of the US dollars, total of liabilities and stockholders' equity, which equals the total of the assets. However, in terms of the translated amount or the adjusted amount, we have a discrepancy because of the translation rates. So with the total assets in pesos of 190,688, I mean 190,688,400 pesos, we have the total of the equities only equal to 190,200,420. And because of this, there is a foreign currency translation reserve gain. Other comprehensive income, it's a credit of 487,980, stated to be your balancing amount. So that makes the total assets equal to the total of the liabilities and the equity. Ano itong tubig ko sa kuryente? Sayang. Ah, this one. Okay, so we now have the verification of the translation adjustment with the current or the closing rate method. The functional currency is the US dollars. Now, with the exposed net asset position of 2,088,000 US dollars, this was taken as the difference between the total assets of 4,737,600 minus accounts payable of 768,000, short-term notes payable 762,000, and bonds payable of 1,080,000. And then we deduct the difference of 39,600. We deduct the difference of 39,600. Okay? So what we have now is 399,600 minus 360,000. So we now get 399,000, I mean 39,600. So the difference as the exposed net asset position of 2,088,000 US dollars, we multiply that by the historical rate of 40 as of the date of acquisition. Actually, this is January 2 rate, so we now get the reporting currency in pesos. Then we have 4 adjustments for changes in net asset position in the amount of 399,600. We have the difference now of 40.20 net income for the year, using the figure above. Net income to retained earnings, and again, the net income figure to be translated by using the average rate for the year. And we deduct the dividends declared of 360,000 using 40.10. And we now get the net asset position translated using the rate in effect at date of each transaction is 85,147,920 pesos. On December 31, our exposed net asset position is 2,127,600, which is taken as the difference between 4,737,600 and 2,610,000. That's the total of the liabilities and equity. So you get 2,127,600 US dollars, and you multiply it by 40.25. That's the rate at the end of the year. So comparing the two amounts, we now get the difference as 487,980. That's the change in cumulative translation adjustment. It's actually our foreign currency translation reserve, which we have included in our combined statement of the income and retained earnings. Then for the condensed balance sheet given, this was on January 2, 2024, when we have the computation of 2,088,000, and we have the amount of the beginning balance considered to be zero, since this was the first year when the investment was held. Now we go to the statement of comprehensive income. This is still by using the current or the closing rate method. We have the net income in terms of pesos, and then we are going to add the foreign currency translation reserve gain, giving us a total comprehensive income here of 16 million. Take note of the addition. That's equal to what will be your total. Okay? So that's your total comprehensive income. Take note, 16,063,920, add 487,980. Now take note of the correct total. Please make correction. So we now have the statement of shareholders' equity as we compare the balance beginning of 46,080,000 of the common stock in pesos. In other words, there is no increase in common stock. Beginning and ending, much more that we are using the historical rate. Then we have the peak and the retained earnings of 23,040,000. 23,040,000. That's your retained earnings as given on the first page. So take note again that we have retained earnings on January 1 is given on the previous given combined statement of income and retained earnings. So again, we have your total, and then we add net income for the period of 16,063,290 or 920 extend, and we also add other comprehensive income. We have to deduct dividends declared as translated. So we have the balances on December 31, 20x4. Your common stock is still the same. Your peak, and then we have your retained earnings at the end of 24,667,920, which you can also find in your combined statement of income and retained earnings. So your total of the shareholders' equity at the end of December. Okay. Then the second is we have the translation by using the second method. So translation into the functional currency using the remeasurement or the temporal method. The functional currency is the Philippine peso. Translation into the functional currency. So take